RWAs, you guys know we love RWAs. You know it's our favorite narrative. Right now the market is dipping, so it's a good time to accumulate some high quality RWA projects, one of which we're going to be talking about today in this video in Trufi. It is a private credit protocol
which specializes in peer-to-peer lending, and also they cater to both enterprise level investors as well as you, retail investors.
So in this video, we're going to be talking about why we're looking at Trufi now, the problem that they're solving. We're going to go through the docs, the white paper. We're going to go through the tokenomics. We're going to do a platform walkthrough. And per usual, at the end, if you stick around, we're going to tell you guys if we are buying Trufi or not and why.
I'll give you a hint. Whatever we say at the end, it's going to be true.
Damn, bro, you just gave it away. Fuck. You ready to hop in?
Let's do it.
All right, so first off, let's start with why now. So like we said in the beginning of the video, I think RWAs are going to the moon for the following reasons. It's attractive to institutions. You have companies like BlackRock building their BIDL fund on ETH. RWA started pumping shortly thereafter. And I'm also really bullish on private credit because right now interest rates are really high. So it's expensive to borrow money, especially for crypto companies and small to medium-sized enterprises, which a lot of the private credit protocols that we've covered in Maple and Clearpool and Goldfinch and Centrifuge kind of cater to. So if the cost of capital is more expensive to borrow in TradFi...
Why are you pointing at me?
If it's more expensive to borrow in TradFi, they can kind of come into this blue ocean and offer lending at a much lower rate. Not only that, this is a hair on fire problem in crypto. And what I mean by that is in crypto, all platforms offer over collateralized lending. And this is the pawn shop model, which is like, let's say I want to pawn my phone because I got to pay some bills. If the phone is worth $500, they're going to tell me it's worth $300 so that if I don't pay it back, they can sell it and make some profits. Now, this is a good thing. It's a step in the right direction, but it's not how people borrow money in the real world, and it's damn sure not how institutions borrow. The reason being is the whole point of borrowing money is getting access to money you didn't have before. You don't want to have to put up more collateral to borrow more money. Like the mortgage example that I always give. If your house is $300K and you want to borrow money, over collateralization will require you to put up $350 to $450K just to borrow $300K. You want to be able to KYC yourself, which a lot of people in crypto don't like, so that people know who you are, be able to track your credit score so there's implications if you don't pay it back. This way, you can actually get access to funds that you don't have.
And to add why we're bullish on RWA protocols, so going into an easing cycle, to keep it simple, that means money, aka financing, is going to be cheaper. And that leaks into DeFi as well. And so if we have cheaper cash in the TradFi system, it translates to cheaper cash in the DeFi system, which also means higher yields on the back end.
Also, guys, private credit protocols had their first quarter in the last bull market. And I'm going to show you guys later on the statistics I'm referring to. But we got up to $1.5 billion in active loans at the heat of the bull market. Now we're at around 400 to 500 million last time I checked. So I think that the second quarter, the active loans is going to be way higher for the reasons I described in the video, as well as crypto has a bigger stamp of approval. We got a Bitcoin ETF. We're probably going to have an ETH ETF. Like companies are just getting more and more involved, not just companies, but mainstream financial institutions. So it's going to be a positive self-reinforcing cycle in that once the bull market happens, the companies that want to borrow that have crypto on their balance sheet's going to balloon. That's going to make them more credit worthy, which means they're going to come and borrow money from platforms such as these. And then platforms such as these who also have crypto on their balance sheets is going to balloon, which is going to make them feel like geniuses. Their appetite for risk is going to increase, which means they're going to be more likely to lend. More likely to borrow, more likely to lend equals a higher active loans, which means higher fundamental value for these projects, which means the price will probably go up.
And let's be real. Institutions are always looking for easier ways to borrow and lend capital out to their counterparts. Now, when these private credit protocols essentially prove themselves, that's going to attract a swath of institutions flocking towards these protocols, whether they're creating them themselves or, they white label some of these protocols, however they do it. They're going to be playing in the private credit space on the blockchain in the very near future. It's coming quicker than we think. And with BlackRock's stamp of approval, it's only going up from here in terms of active loans.
All right, guys. So now that we've kind of set the stage, let's pull the curtain back and dive into the fundamental analysis of Trufi. All right, starting off with what is Trufi. It says Trufi is a modular infrastructure for on-chain credit. We've dove in deep into modularity in a lot of previous videos.
I feel like it's low-key a buzzword now.
Yeah, I mean, basically the word modular means specialization between different layers. So you have a layer that specializes in something instead of one tech stack performing all options.
So in this case, modularity, you can construct your portfolio in the way, as a portfolio manager, in the way that you want it, essentially.
Yep, in multiple ways that you want, to be specific. And you guys will see that as we continue through here. So it says Trufi connects lenders, borrowers, and portfolio managers via smart contracts governed by the True token. Since the launch in November 2020, they've originated more than $1.7 billion in loans to over 30 borrowers and paid more than $40 million in interest to protocol participants. Borrowers include both leading crypto-focused institutions and real-world firms such as fintech companies, trading firms, and credit funds. So they're going after more than just crypto companies and small to medium-sized enterprises. And that's another thing that I like about this protocol in some ways more than others. All right, so let's talk about why should someone lend money on Trufi. It says transactions on Trufi are transparent and publicly auditable, enabling lenders to track every dollar or token lent and borrow, as well as the status and structure of every loan. It gives you the breakdown as to how the lending works, what you have to do, onboard KYC, lend the funds, how to monitor, how to redeem. And then it goes to talk about what activity Trufi supports, which we're going to dive into. So they have credit vaults, asset vaults, and lines of credit. So it's multiple ways to lend, multiple ways to borrow, multiple ways to get a yield. And then it talks about the fees. It says pools pay a protocol fee to the Trufi DAO treasury and an optional fee to the portfolio manager. It's not optional that, oh, I can pay the portfolio manager if I want. It's just if the portfolio manager says they want a fee or not. So don't get too excited, guys.
It's optional to the portfolio manager.
Yeah. And then it says fees are stated on a per annum basis, aka per year, accrued continuously and paid periodically by the portfolio smart contract. So this section talks about how to lend, and it gives you all the steps. And it looks like it's just two. So you have to get approved, KYC, all that, because this is under collateralized lending. And then you just deposit. So it's kind of like staking. It talks about how to withdraw. Lenders can redeem funds once a vault has reached its maturity date, or depending on the portfolio manager's configuration, once liquid funds are available. So if the portfolio manager says your funds are locked for a month, that's going to be the maturity date, and you wouldn't be able to withdraw until the funds are unlocked. And that's part of the modularity. You can have different fees, different lockup periods, different strategies on how to get a yield within the strategies that they offer in credit and asset vaults and the like.
Yeah, and I'm curious as to why they didn't use ZKPs. So Trufi also leverages ZKPs as well when it comes to the lending side of things. But I'm curious why they didn't leverage ZKPs in terms of the KYC, because you have now KYC ZKPs as well. And so I'm curious as to why they only would shield wallet info versus keeping to the true nature of the blockchain and keeping your identity anonymous as well.
That's actually a good point, because ZKPs, they will allow a person to prove that they're a real person and prove that they have the means to pay something back. But I guess even with the ZKP, in order to prove you can pay something back, you have to show some kind of history on who you are.
Yeah, and this credit history is built, we're going to get to that, but it's built on chain based on your history within the pools on the Trufi blockchain.
I wouldn't be surprised if they rolled that out, because that's actually a good point.
Yeah.
And then they talk about the onboarding / KYC for permission pools. So they have permission and permissionless, obviously. So portfolio managers can also, another part of the modularity, configure permissioned pools on Trufi. Accordingly, some vaults on Trufi may require identity verification before lenders can gain access. And then they go on to show you, how to do it. They talk about why you need to verify your identity, which is, you have portfolio managers in different places and they have to abide by different laws in different jurisdictions. And it talks about this. So if they're in a certain jurisdiction, they're going to have to verify your identity so that, they're not breaking the law. And they have pools that are for US investors or some that you can't be in the US. So kind of pick your flavor. All right, now let's talk about borrowing. So why borrow on Trufi? So it says borrowers can find capital at competitive rates from a network of global liquidity on Trufi. Using Trufi's infrastructure, borrowers can gain access to capital markets 24/7 with faster settlement than TradFi systems. Another perk of the blockchain.
Here's a quick little fact. It takes on average 7 days for Trufi from approval to actually getting the loan. So it's still a little waiting period. So all those settlement periods.
Is that for all of the borrowing? Or?
That's on average across the platform, right?
So there would be ways you can get it faster.
Yeah, so you could get it faster or it could take a little longer, right? But still in the TradFi world, this, depending on the size of the loan, it could take like months to get approved for a loan. Depending on your history, depending on the type of loan you're going for, it could take a long time. So it could take anywhere from a day to, let's just say, 6 months in the TradFi world. On average, on Trufi, you're looking at a 7-day settlement period, which is still, on average, faster than the TradFi system.
Yeah, and good point, actually. It's not even just a blockchain perk. Blockchain allows for the advent of smart contracts. So the reason why it's able to be faster is because of smart contracts. And the best way to describe a smart contract is actually a vending machine. So smart contracts do 3 things to keep it simple. They store rules, they verify rules, and then they execute functions based off of those rules. So if you look at it through the context of a vending machine, the storing of the rules is knowing that V6 is a bag of Doritos. The verifying the rules is knowing that when you put $1 in, it's actually real money and not counterfeit. And the execution of actions based on the rules is when you hit V6, it knows to drop the bag of Doritos. So with smart contracts, how that plays into this and making it faster is when you fill out your information, the smart contract is already programmed to say, hey, if it's this, he gets approved. If that, he gets disapproved. Or if that, ask him this question. And, we're still in the beginning, so I'm sure there's going to be things to where they're going to have to go back and like reprogram the smart contract when they get questions or things that they haven't seen before. But eventually it's going to be all ironed out, and it's going to be probably even faster than the 7 days that it is now, because I'm sure they have some level of people reviewing it versus in TradFi, it's all people looking at these things, and people are slow as fuck.
Yeah, in theory, it should be faster now than 7 days, but like you said, you may have someone verifying the information in that smart contract before it's actually approved.
Yeah, but the smart contract does most of the work for you. Like, you're just verifying it. You're not having to go and cross your T's and dot your I's and then verify it on your own, which is pretty tiring because who the fuck wants to read documents all day? Okay, here's another cool thing. It says borrowers on Trufi also have an opportunity to build their public on-chain financial reputation and position themselves to access more capital at better rates moving forward. We're all familiar with the concept of credit, like having a credit score. Eventually, and there are already firms like popping up that's offering this service, eventually you're going to have an on-chain credit score and they're probably going to merge. So a lot of people try to borrow money and not pay it back, but it's going to affect your on-chain score, which will eventually spill over to your off-chain score. And then once everything is on-chain, or most things are on-chain, it's just going to be not as bad. And smart contracts are going to be programmed to not approve you. And this is the part where smart contracts actually hurt you a little more because you can't negotiate with a smart contract like you can with people.
Yeah, and I can see it being used together in a way such as, let's say for some reason in the TradFi system, you get denied a loan for whatever reason, right? I can see them as a secondary tool going to some type of on-chain platform, looking at your payment history that way, or credit history that you build through paying back your loans on time, all that good stuff. And based on that metric alone, I could see them using that as a secondary tool to approve you. Because it's like, okay, even though his debt to income ratio is high or whatever the fuck that loan depot is looking at the time, they'll still see on chain that you've managed to pay back all of your loans on time. Maybe you haven't missed a payment. It's literally a perfect history on chain. And so that could be the approving factor in a lot of TradFi's mind. So I can see it used in tandem, not really like a true integration, but as like a secondary tool for approval. Or denial. Let's say you look good in TradFi, but then they look at your on-chain history and you low-key are a piece of shit when it comes to paying back your loans and paying on time. Well, that's going to be a tool for them to deny the shit out of you.
Yeah. The best way I can give you guys to conceptualize this is, you know how you have your FICO score, which is the 3 credit bureaus combined, right? You have your TransUnion, your whatever the other 2 are. Blockchain is probably going to be its own little thing, so you're probably going to have 4, and then it's probably just going to add into your FICO. So they also talk about how to get started as a borrower. So you onboard with a portfolio manager because they're the ones doing the lending. You can also get a loan directly from Trufi, from the DAO, but we'll dive into that later. And depending on what kind of loan it is, you have to complete your KYB, which is know your borrower terms. And then you negotiate the terms, receive the loan, and then you repay it. Simple enough. And then for receiving and repaying a loan, they give you like step-by-step instructions, which is really good. They give a lot of instructions, more than other private credit protocols that we've reviewed. Okay, so now let's talk about the portfolio managers. So portfolio managers can use Trufi infrastructure to run their own credit fund on ETH and other networks. So it talks about the onboarding for managers. So they basically introduce themselves to the Trufi community and they're vetted by Trufi governance, aka the DAO. During this process, potential lenders can communicate with and learn more about portfolio managers. Then they deploy their fund, aka Vault, on the app. And then once the Vault is live, people can request to borrow and then they can fund their loan. And they, you can play this video on the docs here if you want more information on that. So this is where you go to onboard as a portfolio manager. So we run a hedge fund. If you don't want to go through all the bullshit to set up a hedge fund, it's protocols like Enzyme, or you can do something like this and you can have your own credit fund on Trufi, and they do all of the regulation for you, I'm guessing. They show you how to create a vault, so give you videos on that. They show you how to disperse the loans and all the information around that. And they give you all the information on KYC. So they make it really easy for you to, onboard and start running your own fund or borrow or lend. All right, now let's get into the actual strategies that they allow you to do on here. So the first one is the asset vault. So these are vaults that facilitate off-chain credit.
I was just going to say, to be specific, theoretically, you can run any strategy you want. These are the tools by which it allows you to carry out those strategies.
So it says here, asset vaults represent off-chain instruments by using on-chain attestations or asset reports. So you're doing things off-chain and you're reporting them on-chain. And now we always say you can build centralized technology on decentralized technology, but you can't build decentralized technology on centralized technology. And it says by using this structure, asset vaults can facilitate diverse and complex RWA activities such as deploying capital to off-chain uses, support 100 plus loan instruments in a single vault, floating rate loans, and amortizing loans. And then it also talks about how the assets are audited, and you can also demo the asset vaults here. And it's like a video that you can watch.
All right, so moving on here, credit vaults are smart contracts that coordinate the lending, borrowing, and management of on-chain credit. It says here, credit vaults enable on-chain credit, helping portfolio managers configure modular lending pools that meet their specs, single or multiple tranches, permission access, etc. So here are 3 tranches within a given pool. And so you got senior debt, which means they take the least risk and they're first to be paid out. It's more like maintaining your capital versus taking excess risk, right? When you're lending capital. Let me go equity first. Equity financing is the most risky form. You are exposed to the most volatility within a given protocol or an asset. And so those are usually, if there's anything left after the senior junior tranches are paid out, they'll be the last to be paid. If there's nothing, they're fucked. And then we got mezzanine financing. So mezzanine is really popular within commercial real estate as well. And so mezzanine debt essentially sits in between the senior and equity tranches. And so it's kind of like a hybrid. So it's debt that's convertible to equity in the event that the company defaults or sells or cashes out, however you want to look at it. But it sits right in the middle, and they're the second to be paid out in the event that that protocol is liquidated. And so mezzanine debt, while it does take some risk, it's not as risky as the equity tranche, which means they generate a slightly higher yield than the senior tranche and slightly lower than the equity tranche.
And then also proof that this one is more risky. You can see that for the senior and the mezzanine, it says the APY is fixed, which means they're investing into something that's paying a fixed yield, or else they wouldn't be able to predict that. So something like bonds or some kind of loan, structured loans. But this one is an estimated APY, which means they're probably buying volatile assets, and that's why they're giving you that range.
Anytime you see an equity tranche, it comes with volatility. And so, yeah, it's always going to be a variable rate. So this is kind of what we just touched on, but it says when funds are repaid to the vault, they are distributed by a waterfall, where the most senior tranche's amount owed must be repaid before the subordinate tranche can withdraw. And so they have an illustration here. I'll pull it up really quick. So this is another example of those tranches. This is showing the liquidation process essentially. And so tranche A, which has the lowest yield, that's the senior tranche, they're always going to be paid out first in any event that there's a liquidation, positive or negative. Tranche B, which will be that junior or mezzanine debt, they get paid out second. And tranche C, if there's anything left, in this case 1.5 million, they will be paid out at a variable rate. And so I thought this was a pretty good illustration, actually. It looked like somebody wrote it on a napkin.
Yeah. And they also give you like a credit vault tutorial. They give you tutorials on how to do pretty much anything. They make it really easy, give you all the instructions. And they even have a portion for the technical details for the asset vaults as well as credit vaults. This is a little bit technical for this video. We'll let you guys dive into this. We're just going to cover the high level.
So just to touch on the modularity piece super quick, in terms of portfolio creation, they pretty much show you all of the options you have when it comes to creating a portfolio as a portfolio manager. And so anything you see with an F, it's fixed. Anything you see with an E, you can edit it pretty much anytime throughout the portfolio's life cycle. And so you can see here, you can just read yourself. Senior tranche name, symbol, manager fee, interest rate, all this stuff is pretty fixed, obviously. So that way there are no discrepancies when it comes to repayments at all or the waterfall payout at all. And so this is a good example of their modularity right here, just in case you were wondering when we said that earlier.
So they also offer lines of credit. So it says Trufi lines of credit, also referred to as automatic lines of credit or ALACs. These are lending pools for a single borrower where the interest rate paid by borrowers is determined by a configurable interest rate curve.
So it's funny, I never heard of the term ALOCs until this project. So that's pretty good. You can call it ALOCs or ALOCs. But anyway, if you're familiar with real estate, it's similar to a HELOC, a home equity line of credit. So it's a line of credit against your home's equity. In this case, it's a line of credit most likely against your borrowing history or your reputation on chain. And I'm assuming, let's say if you're a new investor and you wanted to open a line of credit, there's probably some type of tool that's interoperable with other blockchains. So if you have credit on another blockchain or reputation on one blockchain, they should be able to essentially tap in and take that reputation to determine your approval or denial on this blockchain, on Truefi's blockchain. And the way that they determine the interest rate on the line of credits or the ALOCs is through your credit utilization. So if you're familiar with credit cards, you have a credit utilization rating or a number. And that could be, and it depends on how much you use your credit card. If your credit utilization number, that percentage that you're using is higher, the interest rate will increase. If you're only at that minimum threshold for the credit utilization, then you'll be paying a lower interest rate. So the more you use it, the more you pay essentially.
All right, so why use Trufi lines of credit? So it provides borrowers a flexible way to raise capital and lenders a way to deploy capital while maintaining high liquidity. So Trufi lines of credit use supply and demand dynamics to set interest rates, kind of like AVE. When you have more people borrowing money, or the APY for lending is going to go up so they can incentivize more lending so people can keep borrowing money. And we have more people lending than borrowing, the cost to borrow is going to go down to incentivize more borrowing. And this says it gives lenders incentive to supply capital to pools above target utilization rates and borrowers incentive to maintain optimal liquidity ratios in each pool. And then it talks about how interest rates are determined. We just kind of went through that. Each line of credit does have its own specified maturity date. All debt and interest is due by this maturity date. Once the maturity has passed, borrowers cannot draw additional capital and lenders cannot lend additional funds to this line of credit. And then the interest is on a block by block basis instead of on a day by day basis in TradFi.
Which means they fluctuate a lot.
Yeah. Or if they don't, it gives it more room to fluctuate because Ethereum blocks happen every 10, 20 minutes, I forget, versus, on a daily basis, things can change. It goes through the parameters for each line of credit for the borrower and the interest rates. Like I said, they give you all of the information that you need. They have a tutorial on how to create a line of credit, and they also have technical details for lines of credit as well.
Tooling these days with like DeFi protocols is kind of the name of the game.
Bro, they fooling with the tooling. So, no.
The easier you make a process to be carried out by an investor or a consumer, the more likely it will be consumed or used. And so look for this trend. You're going to keep seeing it more where you see all these protocols. If they didn't have tooling before, they have it now. In any new protocol you'll see, if they came without tooling, then they're probably not going to be in a good position because when it comes to DeFi and complex systems that exist within DeFi, of course, not everyone they're not going to know what the hell they're doing pretty much. And so the idea is to make it as simple as possible to bring in a new audience or to maintain your current audience or customers or investors.
Okay, so now let's talk about Index Vault. So this is in beta right now at the time of this recording. So Index Vaults enable fund-to-funds activity on Trufi by allocating capital across multiple underlying Trufi products, such as credit vaults or lines of credit. So basically a fund-to-fund is like, let's say I have a hedge fund, but I want to have a strategy specifically for crypto, and I want to have a fund specifically for stocks. I want to have one that's for fixed yield. I'm not going to do all of that within one fund. So I'm going to have a fund-to-funds where the fund has multiple funds below it. So it's still the same general partner, or in this case, portfolio manager. So that's why they say allocating capital across multiple underlying Trufi products. So you can get access to multiple strategies to kind of have a well-rounded portfolio.
And that flexibility is what will allow them to stand out from other private credit protocols moving forward. It is in beta right now, but when it is released, that's going to be a fire product.
You see why I like this one a little bit more?
I can understand. I was thinking that when I was upstairs.
Again, they have an Index Vault tutorial, and they have the technical details for this as well. Another thing, guys, audits are the utmost important in crypto, especially DeFi. If you're going to trust your funds on another protocol that has access to your wallets and your funds, you want to make sure it's safe. They have multiple audits for all of their different strategies, which is good. I want to see a little more, but it's a good start. These audits are not cheap. So when I see a company that has an audit from a reputable firm, not, a cheap one, and you want to see them actually fixing the things that were like red flags on the audit, and this project has. And they've been around since 2021. So I like it. I do. All right, guys, now let's go through the tokenomics and see if it actually makes sense from a tokenomic standpoint. Because a lot of times with crypto, you can have a good project with shitty tokenomics.
Oh, we just saw a price drop.
Yep. So I like these tokenomics. You can see that. Oh, no, baby. What is you doing? I must have got this mixed up with another project.
Wait. What? That's Trueflation. Technical difficulty, guys. We were looking at Trueflation the entire time.
Yeah, it's the wrong one. Son of a bitch.
That makes sense now.
Okay, yeah, we were looking at the wrong one. So, yeah, most of the tokens have been unlocked. Hey, players fuck up too. It says the market cap's 48 million and some change, and the fully diluted valuation, which takes into account all the tokens, not just the ones that are unlocked, is 469 million. And I think this changed because I was looking at this the other day and it was pretty close. So if you look on here, I believe this is the correct one. You can see that the market cap is 110 million, but you have a fully diluted valuation or market cap of 142.6 million. So most of the tokens seem to be unlocked. And if we look here, you can see that circulating supply, it says a billion. I'm not sure when this was last updated. Oh, March 28th. So a couple days ago. And it's 129 million locked, 223 million left. And it shows like if it was allocated or unallocated to who, the incentive. I couldn't really find the information that we normally do on the videos on like Token Terminal or Crypto Rank or the other websites that shows the issuance schedule. But at least we know that most of the tokens have been unlocked and we're going into a bull market. So I think that the buying pressure will outpace the inflation we will have to worry about. I like these tokenomics. Like 90-something% of them are unlocked. All right, guys. Now let's kind of do a platform walkthrough. So they've raised money from some of the best funds in the business: A16Z, Block Tower, Founders Fund. It's more. Their dashboard is pretty intuitive. It kind of gives me Coinbase vibes.
Yeah, whenever you see a good user interface, unless it's an FTX situation, but even with FTX, you can see how much attention they garner. Part of the reason because they had kind of a seamless and beautiful user interface.
Built by traders for traders is what they used to say. All right, let's go ahead and launch the app. So you can see this fund pops up right off the bat. $20 million. This shows the total value lock. So before we actually do this, let's go to RWA.xyz. So you want to always like see how these private credit protocols stack up to their competitors. So like I was said in the beginning of the video, we saw 1.5, give or take, at the peak of the last bull market in total loans. We're already seeing this start to tick up. Right now we're at 543 million. And you can see that Trufi is in 5th place in terms of active loans, 19 million. But in total loans, they're number 2 behind Maple. So I think that there might be a chance that this thing starts to pick up, just like Goldfinch did. Goldfinch was a great call we made. One thing I don't like is that they have a pretty high cash drag. Cash drag is the percentage of idle capital in the protocol. So you just have to keep in mind, if you were to use this to get a yield, all of it's not going to be used at all times. And that's not necessarily a bad thing. It could just be them just having risk management.
And you can withdraw from those idle funds. So it's not like it's stuck within Trufi. They do allow you to withdraw.
Yeah, and then also, this is an average of all the different portfolio managers. So you can find one that has a 0% cash drag. You know, this is just the average. So that's another thing to keep in mind. So these are some of the funds here. And if we click on this one, let's see what pops up.
This is one of their funds right here, Adapt. So it's essentially a short-term T-bill fund. And so I'm assuming what they do is just take your capital, invest in the short-term T-bills, and then you earn a yield off of that, which probably explains this 5.32% yield right here. But yeah, so this is why they're offering that 5.32% yield at the moment. Probably scalping a little bit off the top.
And it makes sense that if you look down here, it's for non-U.S. investors only, because if you're in the U.S., it would just make sense to buy the treasury bill on your own. But if you're not in the U.S., you can't, but you can still get access to the risk-free rate from the strongest currency in the world.
Yeah, and it's not approved in the regulatory framework yet to start offering T-bills on chain, because that would probably render, according to the U.S. regulatory framework, your project as a security, just because you're investing into securities. And so each fund will have different liquidity preferences. This fund operates on a daily liquidity basis. And so they minimize their cash drag, as Vince was just talking about here, by investing 95% of the assets in that fund at any given time. And so, yeah, you can read through, you can learn more about the fund itself, and then you can decide if you want to invest in the fund. Obviously, if you're in the US, you can't. And it is a minimum of 100,000 USDC, which is $100,000. And max offering is $1 billion. So, I mean, if you got $1 billion, go ahead and hit these dudes up, man. So down here, you can see the activity of the portfolio as well. Down here, you can see when the offering was created back in September, and then it gives you kind of like certain pieces of activity. So the initial investment was about, is that 8 billion? No, 8.5 million. You see the dispersed assets, $1,000 or 1,000 USDC. And so you see that reflect in the next activity report right above it, and so on and so on. So it's a cool way to kind of keep track of the activity of the fund. I am curious how often they're updating this. It seems kind of random.
It looks like they're updating it when they make an action.
You can see all of the details of the actual fund right here. No reports added yet. And you can see the manager profile as well. So you can see who runs this actual fund to give you more confidence in investing your cash or not.
And guys, you can go through the same stats on these funds as well. And it looks like these are the only 3 that they have right now. So, yeah, I mean, if you guys want to start a fund.
And the one at the bottom has no value in it.
Yeah, if you guys want to start a fund, This might be a good place to do it. In terms of like having an on-chain fund, I like this better than all the other private credit protocols that we reviewed. If you want to stake your True tokens and if you want to have a say in how certain actions on the platform work, you can stake, and how much tokens you stake will determine your voting power. Pretty typical with the DAO. This is how you manage your vault. So if you want to be a portfolio manager, you have to have, this is a button to apply and you can create your vault, etc.
And staking is always good. I mean, let's say if you're a US investor and you only want access to like the T-bill fund, but obviously you can't have access to the T-bill fund. And so because of that, you still want to find a way to generate yield from owning the True token. We'll stake your token for a fixed yield. It's relatively risk-free. The risk lies within the protocol when you stake. And I just think it's a good way to stay involved. So,
all right, for all you rascals who stuck around to the end, would I buy Trufi or not, and why? The answer is yes, I would, yes, I am, and yes, I have. Reason being is because, RWA narrative, private credit protocol narrative, I like that they're number 2 in total loans. That makes me think they'll have a good chance to catch up as we get deeper into the bull market and people and companies start to borrow money. I like the modularity and the flexibility of strategies.
Modularity.
That's how you say it.
Modularity.
And this fucking guy. I like the flexibility that they give you on being able to implement your own strategies, control the KYC. You can do it from multiple places. I like it. It's pretty simple, but it's also gives you enough complexity so that you can do your thing.
Yeah, no, I actually agree with the modularity side of things. This is kind of an obvious buy. In terms of the competition, they're probably the most easy on the eyes as well. As you know, no matter what project it is in the crypto space, how it looks matters. And the fact that they have kind of a Coinbase vibe to it, obviously that's going to help. They did a great job with the user interface and the flexibility that they allow their PMs to have within the platform and multiple ways to gain exposure to the platform and participate in the platform. I wouldn't say it's unmatched, but it's pretty damn good. And because the tokenomics are still at a point where
That's another reason.
Yeah, you can see that it's low key still undervalued. We're still a small market cap, right? And obviously, when it comes to private credit protocols, $1 billion market cap for a good private credit protocol is still small. And so if we're talking about 100 million, well, we're still pretty early. Going into this easing cycle, as I said in the beginning of the video, it only makes sense that private credit protocols and lending protocols in general in the crypto space, as long as they have their infrastructure in a row, they should do pretty well as the cost of capital starts to come down significantly.
Yeah. Are you buying it?
I am buying it. Already have, already will, and already do.
Damn, I didn't know you were omnipotent.
Yeah.
So guys, before we go ahead and wrap this up, as you guys know, we have our own personal channels. Follow Jay Mansion, follow me at Crypto Noah. I'm going to be releasing my step-by-step take profit strategy video on Trufi to show you how you can potentially turn $20,000 into $1.1 million by investing into Trufi and yield farming, which means accumulating it passively. By the way, we do have a yield farming course that shows you all that stuff. If you want to book a free strategy session, click the link in the description. We're printing money over here.
Printing money.
Yeah.
We're basically J-Powell.
Basically. So with that, we thank you guys for tuning in. Let us know what RWA protocol you want us to cover next. There was a lot of people asking us to do Trufi, so here it is. But like, comment, subscribe. We appreciate y'all for watching. And we see y'all in the next one. Peace out.